Hi everybody and welcome to the EDPF and PropDD collaboration. Today we have Sean Godway and Justin Leaf from PropDD who are going to present to us what due diligence is all about, why you need to do one, and how to do it. So I'm not going to spend any time talking about it. I will allow Sean and Justin to introduce themselves and they will then do their presentation and talk to us about due diligence. Sean, over to you.
Awesome. Thank you, Nigel. Great to be here. Thanks for the opportunity. We're very excited about the collaboration with the EDPF to assist in our own small way with the fantastic work you do. So yeah, big hello and welcome to all your students and the general public who may be viewing this. It's a great opportunity for us to discuss a really important topic within the residential property industry, which is very often overlooked, even though it can solve a lot of issues and add a lot of value for both sides of a property purchase or transaction. So yeah, today we're going to delve into that topic and take you through that. Just to start, I'll do a brief introduction of myself. So I'm co-founder of PropDD with my partner and co-founder Justin Leaf. My background is in market analysis and strategy. I've worked in SA. I studied property at Wits and I also worked in London for a couple of years. I came back and I worked through my own consultancy and so co-founded the SA PropTech Association. And obviously more recently, we've started this really exciting venture into something we're very passionate about. So that's me. Justin, I'll hand over to you.
Nigel, thank you. I echo Sean's sentiments and we really appreciate this opportunity to present to the EDPF Property Academy students. My background is also a co-founder of PropDD and I've been involved for the past 2 decades in investment property deal facilitation, as well as due diligence advisory at the transactional level, so surrounding property transactions. And more recently, I co-tutor a property short course with Sean. And yeah, so that's pretty much my background in a nutshell.
So just a sec. Yeah, so there we go. As we said, yeah, we're going to be unpacking property due diligence today. So to start, Justin's just going to take us through what we'll be going through today.
Right, so we're going to focus on key points of discussion around the concept of property due diligence. And so we've broken that up into 5 segments. So the first segment will be what is due diligence and why do it? Which Sean will present. I will then take over to discuss the risks and how to de-risk surrounding a property transaction specifically. And then we'll move on to the due diligence clause in the sale agreement, how to protect yourself in essence with a due diligence clause. And then we'll use our product, the PropDD residential toolkit, to break down that due diligence process and to understand the various stages of the due diligence, which we like to think that we've simplified that process into the key stages. And it doesn't necessarily need to be a very complex process if it's done systematically. And then we'll share some useful resources to assist with the process, particularly around collecting information and data that's relevant to the due diligence process. So should we move on to the first segment, which is what is due diligence and why do it? What is it? Why is it so important?
Great,
Sean, over to you. Thanks.
Good stuff. So we've got a brief description we've put in place. Obviously, if you go out there, there'll be a number of different descriptions and definitions, of due diligence. It's a bit sort of opaque, or there's not a lot of clarity on what exactly it is. In the commercial industry, it's very well established, and a seller of a commercial property will provide a DD pack, and then the buyer will do a thorough due diligence, which follows the same principles as we have here, focused on the residential industry. The reason why it is important and it needs to be done is that there is, like I said, there's not clarity on what this involves, and in many property transactions, a lot of information and potential risks are overlooked. So to come through to our definition, a due diligence process is a thorough investigation of key information and characteristics of a property before purchase is finalized. So this includes a focus on general information, legal, technical, and financial considerations, as well as the all-important physical inspection. So while desktop studies are important for gathering that information, like Justin said, considering legal issues mostly through gathering relevant documentation and verifying that, and looking for any potential issues. Technical things like plans and financial elements, mostly to do with the running costs of that property, whether you're a buyer or an investor. For an investor, it's important because obviously it affects your end return. And then the physical inspection, a thing of key characteristic of property is obviously it's physical. It's not like dealing with an equity where you may do due diligence on the underlying company. So you need to kick the bricks, so to say, which is a great saying in the industry that we quite like. So in a nutshell, that's the definition of due diligence. And then why do it? So basically, it's from the buyer perspective, the seller perspective, and then a joint perspective. So for a buyer, which we touch on in the definition, key aspects need to be understood, such as the condition of the property and the various points that I just highlighted. And all of these feed into the suitability of the property. So does it meet your needs? Will the cost be too much? Are there potential risks that may lead to significant maintenance or repairs, etc.? And then do legal restrictions have an impact into how you will use that property and its utility for you? So all of this is to basically help the buyer to fully understand risks, responsibilities, and costs related to this property that they would like to purchase, and to make that final decision. So this really is a process that is important for any transaction, and we feel that a level of due diligence should be carried out for residential purchases or transactions before the actual transaction starts, before firm offers are in place. Although obviously, once the offer to purchase or the OTP has been signed, Justin's going to take us through how that a DD clause in that document can also allow you a period to investigate. But more commonly it's before that happens, but it can obviously happen once you've made an offer, which can be quite a good situation for the buyer. So all of this helps the buyer basically to approach the purchase and the property with their eyes wide open. And like I said, we just feel it's really crucial because it isn't implemented generally, or on the whole, it isn't implemented in a way that really extracts the value for the buyer and both this and the seller. So we're quite passionate because we think it can, we feel that it'll drastically increase transparency, and this just means better transactions, less comebacks, and happier buyers, and then happier sellers who would likely reduce the selling time, and then the actual offer process, and then a lot of this information will feed into the transaction, or the transfer process, which will really help. So on the seller side, this is also important because if they choose to initiate the due diligence, this can basically fully address the disclosure requirements that are now even more onerous due to the Property Practitioners Act. So full disclosure is important, and if not, it can really lead to legal issues for the seller and the agent. So basically, if they complete or at least start the due diligence process, they can provide this information upfront to interested buyers. So you check in that box straight away, which is fantastic. And then at the end, this is really a two-way street. So a good due diligence will need to be the product of cooperation between both parties. So for the buyer, when they're doing their due diligence, they'll need to request various info from the agent and from the buyer to carry out the investigation effectively. There's a number of documents, etc., available publicly that they gather themselves, but much of it, it would be the duty of the agent or seller to provide that if they really want to move the sale along. And if they truly are disclosing fully, they should cooperate, because all the information we include in the toolkit is relevant, and most of it the seller or the agent will be obliged to provide, which is important. So that collaboration is really key. So yeah, in a nutshell, that's what due diligence is and why it should be done and why it's important. And yeah, benefits are for all parties in the overall industry are quite clear to us. And yeah, I hope that this has demonstrated that and provided the little foundation for our presentation. So moving on.
Thanks, Sean.
Look at
so just to recap on what you've just said, two very important points which I made note of is kicking the bricks kick the bricks, which is similar to kick the tires when you're buying a car or a second-hand car. So in essence, when you buy a second-hand car, you want a full service history from the dealer. And in the same way, I suppose the due diligence process is the same with property. You want a full service history of that property in order to eliminate those risks and to walk into the deal with your eyes wide open, as you mentioned. And the other thing is also successful.
That's a fantastic way to demonstrate, or an example is that full service history.
100%. And the other thing that it's important is the successful outcome of a due diligence process really depends on the level of collaboration between a buyer and a seller. And that's why we're so passionate about due diligence, because it can really turn the industry around, where sellers who hold that information can make full disclosures, which should translate into a much better deal, a more quicker sale, and certainly a successful deal for a prospective buyer or investor. So moving on, risks and de-risks are basically understanding exactly the risks surrounding a property and how to de-risk using the due diligence process. So due diligence is really about identifying and finding ways to de-risk the investment, as well as to ensure that the investor is actually walking into the deal with their eyes wide open, as you mentioned. This means that not only identifying the risks, but also the responsibilities, costs associated with the investment. Even though South African law affords a buyer protection under the various acts, examples being the Consumer Protection Act and the newly introduced Property Practitioners Act, all risks and benefits associated with a property pass to a buyer once they've taken legal ownership of the property that they're purchasing. So to illustrate the types of risks that could be encountered, I've highlighted these three examples, but it's really important to remember that no two opportunities are necessarily the same, and that the scope of risk can vary widely. But these are really illustrative of the basic risks that one can encounter. So moving to legal issues arising from restrictions, one of the most common risks are potential issues that come about after a property has been purchased. So one example could be restrictive conditions that are contained in the title deed of a property, which could limit either the use or future potential of the property. One example being a servitude, for example. So scrutinizing the title deed will help inform the buyer as to whether any restrictions are likely to impact their ownership, and to give them the opportunity to determine whether such restrictions can be overcome. And the title deed also serves as proof of ownership of the property, as well as to confirm other details such as the size of the earth, and also whether there's a bond registered over the property. Another example is the zoning of the property, and again, the limitations that the zoning places on the use as well as future intended use of the property. So you cannot simply purchase any residential property intending to build an apartment block without knowing whether the zoning of the property will in fact allow for this. So investigating the zoning of the property up front can also help the buyer limit risks and inform their decision-making before they conclude the purchase. Moving on to defects, I've phrased it disclosure versus detection. And the reason I say that is because even though the new Property Practitioners Act places a heavier burden on sellers to disclose defects in their property when they sell, a buyer can still run the risk of encountering defects which the seller could be unaware of at the time of the sale. So these could be very, very costly to rectify, and even oftentimes hazardous. So to give some examples, there could be structural issues with the building, a leaking roof, defects in the plumbing, a faulty geyser, not to mention illegal building structures such as a carport installation, for example, that doesn't have approved plans. And all of these can go undetected if they're actually not properly investigated during a formal inspection process. So conducting a thorough and well-documented inspection of the property is vital, and will allow the buyer to address any defects or issues up front. Just another point that I should mention is that where any issues are detected during the due diligence process, it can lead to further price negotiation, which could be to the purchaser's advantage. Moving on to the financial impact, two aspects that should be looked at: capital and cash flow. Whatever your purchase strategy is, whether you're buying to occupy, rent out, or renovate and flip, you need to fully understand the financial requirements upfront, as this can heavily impact on your available capital and future cash flow, especially when you're taking on debt. So this means that a buyer should really carry out a thorough assessment of the financial requirements for both the purchase and the operation of the property. Understanding the upfront costs means accounting for all transfer and bond registration costs, how much financial gearing is required, both of which requires sufficient capital from the buyer. It also means accurately assessing the monthly operating expenses, which are often not accounted for by a buyer. So examples being the municipal rates and taxes, city improvement district levies. I mean, the list goes on. Monthly insurance premiums, sectional title levies, Homeowners Association levies, security and cleaning costs, property management fees, maintenance repairs, also a budgeted sinking fund to cover capital items such as a geyser. And also over and above these expenses, the buyer needs to account for the monthly bond repayments if they intend financing the property. And lastly, if the strategy of the buyer is to purchase an income-generating property, then they should work with a logical cash flow model to determine whether or not the property is going to be financially feasible, and obviously is viable relative to their financial circumstances. Okay, moving on to, so that's pretty much risks and de-risks in a nutshell, and hopefully those illustrative examples provide a sort of a fair understanding of the risks that could be encountered and how to deal with them. Moving on to the, here we go. So we're on that slide, protecting yourself in the sale agreement, right? So I've broken that down into 4 main points. The suspense of condition for the buyer's, the due diligence clause itself is a suspensive condition for the buyer's benefit. It enables cancellation without consequences, being the sale agreement. The wording of the sale agreement is very important and often requires some assistance from a legal professional. And also, I'm going to explain very briefly how to minimize the time frame for the due diligence process in the sale agreement and the reasons why that's so important. So aside from the multitude of warranties that a buyer could insist on in a sale agreement, the inclusion of a due diligence clause is absolutely vital where that process is necessary. So in the traditional way of concluding a sale of a property, buyers often negotiate to include a due diligence clause in the sale agreement, whether with the seller or the seller's estate agent. So this is common with, or very common, I should say, with commercial property sales, and there's really no reason why they cannot be considered for a residential sale. So in essence, the due diligence clause enables the buyer to satisfy themselves as to all aspects of the property and to ensure that there are no risks, conditions, or any negative aspects of the property that will, in the ordinary course of business, prevent them from proceeding with the purchase. So by inserting a due diligence clause in the sale agreement, the sale becomes suspensive upon the buyer's due diligence being fulfilled and to their satisfaction. A due diligence clause inserted in the sale agreement is really a suspensive condition of sale, meaning that the entire validity of the sale agreement will depend on the buyer completing their due diligence process to their satisfaction. If the buyer is not satisfied with the outcome of the due diligence process, then the due diligence clause will entitle them to cancel the sale agreement without any financial loss, particularly forfeiting their deposit, for example. So it would make provision for the deposit to be repaid if the DD is unsuccessful. It's important to ensure that the due diligence clause is clear, comprehensive, so that the buyer and the seller fully understand what is required in order for the due diligence to have a successful outcome. So, for example, the buyer could list all their DD requirements in the clause, item by item, and also state that the seller will be bound to cooperate in supplying the information and documentation in order for the buyer to fulfill that DD process. It may require, as I mentioned, the help of a legal professional to assist with the appropriate wording of the clause. And it will also ensure that the clause aligns with the buyer's requirements in the most appropriate way. Another very important point to make here is that when a due diligence clause is inserted in the sale agreement, one can assume that the due diligence will be completed while the agreement is in force. But if the buyer starts their due diligence process well before signing the sale agreement, they can then reduce the time frame for the due diligence being fulfilled in the sale agreement, making the offer more attractive to the seller. And the buyer can exclude the due diligence clause altogether if they are able to complete their due diligence before signing the sale agreement. So that pretty much explains the due diligence clause in a nutshell. Sean, I think we can move to the next slide.
Great.
Right.
Yeah. So I think, Justin, let me run through this quickly, and then I think you're going to share your screen. If that's correct. So the actual process, like we said, there's different stages and different focuses or topics that are really key to a due diligence process. And structure and a pragmatic approach are really important because you're dealing with a lot. So if you just went into it and started gathering, this and that, and putting it in a folder, it's not really going to lend itself to an efficient process, and you may miss things. So Justin's we're going to actually use our toolkit to run through these stages because it's very clearly laid out in the actual toolkit, which is our main product. So these are entering the deal, legal assessment, technical assessment, and financial assessment. So I'll just stop sharing.
Thanks, Sean.
Sure.
Okay, let me quickly call up my, sorry. Right. Technology. Can you see that? Right, Sean, is that visible? Can you see that? Okay.
Sorry, yes, I was on mute.
Okay, no problem. So I'm gonna just jump into a sample due diligence toolkit very briefly. So we'll cut through the dashboard and open toolkit. Right. Okay, so I think we should run through this relatively quickly for the sake of time limitation. So as you mentioned, 4 primary stages of the due diligence. You mentioned legal, technical, financial, and the first stage is really entering the deal. So that begins with the sale agreement, and obviously very important to ensure that the due diligence clause is correctly worded in the sale agreement. We're not going to go into the actual wording right now, but this is just illustrative of the stages of the various stages of the due diligence process. So you would start with the sale agreement and ensure that obviously all the conditions of sale meet the requirements of the offer. Next, you're going to obviously identify fixtures and fittings that are included in the sale, and then also to familiarize yourself with the property information. Again, moving on to important as well to identify the seller's status. And why we say that's important, because if you're buying a property from a VAT registered purchaser, you are going to have to pay VAT instead of transfer duty, never both. So it's important to check, you know, what is the status of the seller in terms of what entity are you buying from, and whether or not they are registered for VAT. It's also important now with the Property Practitioners Act to verify the status of the estate agent and the estate agency that's been mandated to sell the property. So that is an important verification process, and agents are now required to display their status on all their collateral, whether it's you know, their marketing material, in their letterheads, etc. And then moving on to the all-important inspection, property inspection. It's very, very important to carry out a thorough property inspection to ascertain if there are in fact any defects that the seller might not necessarily be aware of, which is what we pointed out early in the discussion. So here it could be the condition of the building with all the various subsections. It could be condition of the building interior. In this instance, this particular property didn't have many issues. There weren't any issues that were in fact detected. There was in fact an issue with the air conditioning system, if I recall correctly, which was brought up. And then moving on from the entering the deal into the legal assessment, and this is really all the legal requirements that relate to a property acquisition. So starting with the title deed, always important to request a copy of the title deed, and as a buyer you are well within your rights to do so, and often a competent estate agent can assist you in obtaining that. But there's also, as we'll show later, there are resources online where you can in fact order a title deed from the local deeds office. Again, surveyor general diagram is important. It also can pinpoint if there's any servitudes on the property. The zoning certificate, very important because it relates to what your intended use is for the property, as well as future uses. If you intend to develop the property, you need to know what the zoning will allow and disallow, and also whether a rezoning is necessary. Valuations and appraisals, a very, very important facet of due diligence. Familiarizing yourself with the value of the property up front is vital. And then moving on, again, something that doesn't often crop up is the question around insurance. And how much is that insurance going to cost you to own that property? And one way of doing that is to request a copy of the seller's insurance policy schedule, because that identifies any specific risks that are covered, and then also gives you an indication of what the cost will be to the monthly insurance premium on that property. With sectional title properties, it's very important to request a copy of the management and conduct rules, as well as the latest financial statements, and not to mention the copies of the minutes of the most recent and relevant AGM meetings. Those are the meetings of the body corporate. If, for example, sorry, just moving on to a property in a state, which is usually governed by a homeowners association, and similar to a sectional title property, you would need to ask for the constitution, the latest financial statements, conduct rules, architectural and landscaping guidelines. Those are very important, because if you're intending to build a house within the estate, you need to know if there are specific guidelines that limit the design of the property, and obviously any other regulatory homeowners association documents. And then moving on to a tenancy assessment. If you're buying a property that already has a tenant, it's very important to carry out a thorough due diligence on the tenancy itself. So you'll want to inspect the leases. You want to check when the rental's been paid by requesting, either statements, rental statements, or confirmation from the seller as to when the rent was paid. And then also to ascertain any additional charges that are recovered from the tenant, such as electricity, water, etc. And very important is to request a copy of the lease documentation, any renewal agreements, any annexures that might have been entered into. For instance, there might have been a additional space that is rented from the seller, from the landlord in that case. And then also to request the statement of the deposit that's held by the seller. You want to know that they've complied with the relevant laws, and that that deposit has been placed in an interest-bearing account for the benefit of that tenant. And then also to identify any issues that may impact your purchase in a meaningful way, which is very, very important when you're buying a property with an existing tenant. You also want to know that the seller carried out the proper due diligence on the tenant when they first entered into the agreement. So carrying out credit checks, doing an affordability assessment on the tenants, also very, very important. So that's pretty much the legal assessment covered. We'll move on to the technical. Technical assessment ties in with very much with the property inspection, which we covered under entering the deal. And this is really about your plan for the property. What is your strategy, and why are you purchasing, and what is the intended use? Are you looking to invest? Are you looking to develop? So very important, the starting point is to request a copy of the approved building plans. And also, if you're buying an improved property with building structures on it, you want to make sure that the approved plans correspond correctly with the structures. You don't want to be buying a property that has structures that there's no building plans that exist for it. So that's a potential hazardous scenario which needs to be verified and checked. And then moving on, also again, depending on your strategy for the property, it may involve calling on professionals to help with the due diligence process. So that could be a building inspector to assist with ascertaining if existing structures are legal. An architect could do the same. A building contractor, let's say you intend renovating the property, you want to get at least some indication on the cost to renovate that property. Let's say, for example, your strategy is to fix and flip. You want to know upfront what those costs are going to be, so that you can build that into your cash flow model and ensure that you're making a profit when selling. Again, a structural engineer is very, very important. If there's any sketchy building structures that might, in fact, look problematic. So a structural engineer can be called in to check the integrity of those structures, those building structures. Again, a town planner can help you. That ties in with the zoning of the property, and to provide solid advice on whether the intended usage of the property satisfies your strategy, and also whether you need to look at rezoning the property to meet those requirements. Moving on again to the all-important certificates of compliance. Now, these are absolutely vital, and in most instances, they are prescribed by law, such as an electrical COC, electric fencing. In certain provinces, particularly the Western Cape, a plumbing or water installation certificate is compulsory. But then there are other areas depending on the type of property. So if there's a gas installation, you should request a gas installation certificate of compliance, a beetle certificate. If there's substantial amount of glass built into the structure, you could request a glazing certificate of compliance. And also what's becoming more and more relevant is the occupancy certificate, which indicates that pretty much the property is fully compliant, and that all the plans are in fact compliant as well, because an occupancy certificate cannot be provided if in fact there are certain aspects of compliance that are outstanding on that property. And then moving into the financial, and just very briefly, the financial assessment is really about, it ties in obviously with your cash flow, but it's also about ascertaining the monthly operating expenses on that property relative to your strategy. Regardless of whether you're buying to occupy the property, to rent it out, or to fix and flip, you need to know what those operating expenses are. So here we've listed them quite comprehensively. Your municipal charges, which is your rates and taxes. In most cities, you have a city improvement district levy, which is payable. Moving on, you've got insurance premium, a sectional title levy, or homeowners association levy if the property is in a residential estate. Security costs, cleaning costs, property management fees if you intend handing over the property management to a third-party property manager, maintenance and repairs, a sinking fund, very important. A sinking fund is often misunderstood. A lot of people think it's, in fact, part and parcel of maintenance repairs, whereas it's not. It's really a provision that should be made for major repairs, which are not carried out on a regular basis. So it could mean replacing the roof every 5 years, or an ad hoc replacement of the geyser installed on the property. So these are pretty much unforeseen or irregular expenses that are generally of a capital nature. And then, so Sean, sorry, I know that I've covered pretty much all the bases of the due diligence, but I wanted to also perhaps chat about the various cash flow models that we've built into the toolkit, which you might want to chat about.
Yes, so there's some supporting resources that we have in the toolkit. So there's various calculators. So buy to occupy, this includes costs that are relevant to an owner. So it'll be monthly costs in addition to your bond payments, etc. So we plug into Uber's calculators so that transfer duties, bond payment, etc. can be included. And then there's a number of running costs that you would need to be aware of, like rates and taxes, perhaps regular maintenance, and such things. So this is really important to assist in a buyer really understanding the affordability of the home, because it does go beyond, just your bond repayment. So you can see there's some examples of costs that could come in, like I said, rates and taxes. If it's sectional title, your levies are really important, perhaps estimates of insurance and security, etc. Sinking fund, that's basically putting money aside for any unexpected costs or big repairs. And your utility costs, that's your water and lights, etc. So this, like I said, is for the owner. And the next one considers this for buy to let, so the same costs, and adds the income, obviously, so your rental income, etc. That comes in. So if you're an investor, obviously your NOI is really important. So that's your net operating income. And if you, obviously that involves subtracting your operating expenses from your net income. So this calculator helps you to carry that out concisely and easily, and then it actually provides your projected return at the end, which is quite helpful. So this should tie into some of the content that you're obviously studying. And then the third one is buy to flip. So that includes considerations, obviously, if a property is bought, renovated, or improved in some way and then sold. So your holding costs are a factor of those basically operating costs that we covered in the other calculators. And then in addition, your costs will be the purchase costs, the renovation costs, and at the end, your estimated sale value will be quite important, and then you get your returns at the end of that. So these are just to help add as an additional resource, because the due diligence that we've obviously gone through includes various elements that are quite important, and then obviously owning a property and purchasing for investment purposes, you need to do financial feasibility, which is really important. That informs the investment performance of a property and helps you in your decision making. So this is just an additional resource. There's also a quickfire market analysis guide. So this you might also cover in your course, but it's basically step-by-step guide on what areas or levels of market analysis there is, and how to understand those, and what information and data you need to include. So again, this is a really important element just to help the understanding of the markets, which again is content that you may cover in your course. Because often you hear it's a buyer's market, seller's market, but what does that actually mean? Is it a good time to buy or sell? So just having a basic understanding of marketing conditions and the impact of economic conditions is really important. And at the end, we have a list of useful resources that helps you gather the data. So the guide itself is an additional resource. So the calculators, etc., are obviously, if you purchase a toolkit, you get access to these. I'd recommend watching the video that's freely available on our website, though. It summarizes this and the kind of key elements of a market analysis. So in your own time, you can perhaps have a look at that. Then, yeah, so those are the resources. So the next element of our presentation, just to end off, is actually providing some useful resources as well. So I'll share again, I'll share the presentation. Just do that quickly. So like I said, you'll get this presentation. So you'll be able to obviously see these. You don't need to make a note of them. So there's a number of things that help you gather property data, sales data, properties for sale. Some of the information is freely available, like Property 24 gives you some interesting neighborhood stats and sales. The information won't be that specific on properties themselves sometimes, but it is a really useful resource, especially considering it's freely available. SG diagrams, which Justin touched on, you need to get those directly from the Chief Surveyor General. So that's obviously a public entity. Title deeds can be obtained from My Deed Search as an example, or CMA and Lightstone also offer quite a lot of information, and Lexis Windeed as well. STBB is our legal partner, and obviously a lawyer will be important on various steps in a conveyance, obviously during the home buying process. Inspections are really important. So this applies to part of your due diligence, which obviously we provide that mechanism for a physical inspection to be carried out. It's also quite important for rentals. You need your ingoing, outgoing inspections to avoid any disputes of damage, etc., that's occurred during the term of the lease. So examples are Property Inspect and My Home Check provide really good platforms for that. And then of course PropDD, we need to pop that in there. It's probably the most valuable resource that you can obtain, but we might be slightly biased there. So here's just those ones I ran through. The websites are here, and there's a list. So there's those 2 pages. So yeah, that brings us to the end of our presentation. I hope you found it useful and engaging. You're always welcome to reach out to us via the website or on LinkedIn. So we're always happy to engage, hear feedback, or answer questions, etc. On this. And yes, I recommend the website. Like I said, there's some interesting stuff on there as well. So yeah, it's been a great opportunity here. Yeah, I think we've enjoyed it. And yeah, thank you for your time, obviously. And we look forward to the live session where we'll actually engage with you in a live Q&A, because I'm sure there's various questions and perhaps comments you'd like to share. So yeah, that's it from my side. Justin, if you have.
Yeah, thanks, Sean. It's been a great presentation, and I'm actually looking forward to the Q&A session as well. I love talking property, and I'm sure the students will as well. And so yeah, I mean, it should also prove to be a valuable experience for everyone.
Guys, thank you very much for your time. This has been absolutely amazing. I personally have learned quite a bit, and I too cannot wait for the live session when we bring not only the EDPF students together, but also the public will be allowed to come in and ask you whatever questions they have. So thank you very much for your time. I know you guys are quite busy and your time is valuable. So we really, here at the EDPF, we appreciate you. We appreciate the time you've made for us. And we thank you very much from the bottom of our heart for teaching us all about due diligence. And hopefully, when this pandemic is all over, we'll be able to have a live session like this in person and maybe go into a little bit more depth into each of those topics that you touched on today. So guys, thank you very much again, and we'll talk to you again very soon.